3 reports that came out that were negative for the economy and for the stock market as well. The producer price index, the wholesale index, the consumer price index, CPI, and retail sales all were weak, weaker than expected. I'll cover that. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is February 20th, 2024. Okay, I'm going to play we got a lot to cover. So we'll get into the producer price index, consumer price, retail sales, what all of this means for the economy and for the market. Hard landing, soft landing, no landing. And where the trajectory that the market was on and where it is today. I'm going to begin with a clip showing an interview with Joe Kernan and Sarat Sethi, managing partner of DCLA. And he covers the fact that with the producer price index, when that came out, was higher than expected by quite a bit, and it really caught the market by surprise, caught economists by surprise, the projectors, those projecting the market by surprise. And his comment is that inflation is going to be higher for longer, probably the case. So what we've got is we've got rising inflation, therefore probably rising interest rates, or at least not dropping as they had expected, but you could make the case for rising, it's what he says, and retail sales are slowing down. And the other thing I covered a couple of weeks ago was commercial real estate, which is got about $1 trillion of loans that are rolling over and going to be refinanced this year and next year. And what that means is, particularly in light of what I just covered, what that means is that the banks are going to be requiring higher down payments or equity, higher equity in the properties, and that the vacancy rate is higher, the interest rates are higher, and what's going to probably happen is that the owners of the properties are probably going to hand back the keys and say, I don't think so. And what that's going to do is kind of like 2008 happened with the residential market. What's going to happen then is it flows downhill and is going to hit the banks. And I think as a result of that, I don't see a way out of it, because all of those are clear trajectories. And probably what's going to happen is, at least in the regional bank side, probably quite a few bank foreclosures. So anyway, I'm going to turn it over to this interview that Joe Kernan does with Sarat Sethi, and let you listen to his view on it.
Joining us to talk markets as we get close to the opening bell, Sarat Sethi, managing partner at DCLA and a CNBC contributor. So we got CPI now and PPI. We had retail sales kind of weak. I'm not ready to say stagflation necessarily like Rick, but it certainly has the feeling more than last week that might be something that we're looking at, Sarat. Maybe a little bit of a slower economy, but persistent inflation, which is like the worst of both worlds.
I mean, if that is the case, yes. I mean, we're definitely in for higher for longer for interest rates. And I think on the economy side, it'll be interesting to see, because if things do slow down, what will be price takers, and will companies be able to keep on raising prices, and will wage increases still happen? So I think there's going to be a little bit of a lag effect on that as well. But in terms of the stock market, I think it'll make things very interesting, because what you really want to do is say, look at, well, what are the alternatives for investors? So higher yields means interest rates are higher, we can buy more bonds. So there's an alternative. Secular growth stories are going to be really important. So I think that's where some of the capital is going to flow. So I do think there will be opportunities, especially if rates stay at this level for a while longer.
Next, another interview with Joe Kernan. Now, this happened on a different day. So as I was trying to find these YouTube videos, I know it's a different day because he has a different color tie on. But it's same theme. And so he's interviewing Scott Cronert, who is the head of equity research for Citi Research. And so he starts by focusing on the Magnificent Seven, the 7 largest stocks. 20% of the earnings of the S&P is coming from those 7 companies. 493 companies' earnings make up the remaining 80%. Just gives you a sense for the magnitude. And size-wise, those 7 make up 28% of the S&P 500. These stocks have they're very hot, and they have become overvalued, quite a bit overvalued, and in my opinion, and I think he alludes to this, are kind of risky from here. He made an interesting observation, and you listen for this, that these companies can continue to grow, but their stock price will not. Isn't that interesting? Because what's happened is investors are always anticipating the future, and if they think these are starting to run out of steam or that they've already gotten the gains that they want to get, future growth is not going to be as easy. He mentions this toward the end of the interview, that their firm believes that the estimated S&P 500 price at the end of the year is 5,100. Today, the stock price is 5,000. So that's a gain of $100 on a 5,000 value S&P. What that means is from here to the end of the year, if he's right, so I'm just going to put a big caveat, if he's right, what that means is a 2% growth from here for the S&P 500. So that's 10 and a half months, 2% growth. So I'm just putting, he didn't say that, but that when he uses that number, that's what that means. So it won't be a straight line, and 2% is almost nothing. So what it means is probably a whole bunch of ups and downs between now and the end of the year, and that would not surprise me. So take a listen to this interview with Joe Kernan and Scott Cronert.
For his thoughts on the mega caps, let's bring in Scott Cronert, head of U.S. equity strategy at Citi Research. All right, granted, maybe we still are at the Magnificent Seven. We remember who they are. We've taken some out, and we've played around with the Fabulous Five and the Fantastic Four. But let's do the 7, Scott. What should we do with those? Are they going to lead this year as well?
Well, I think you have to hold them. I mean, that's our view. Is we've been, consistently overweight tech, and the premise has been you want to hold on to these mega cap growers. They're earning their weight, if you will, in the indexes as a function of the fundamental dynamics underway. And aside from that, we do expect the market to continue to broaden as the year unfolds. But Magnificent Seven, Big Seven, whatever you want to refer to them as, they're 28% of the S&P 500 now, and they're contributing about 20% of earnings, and that's up from only 5% of earnings back in 2017. So our point here is that the business model maturation of these companies, the turn to profitability and significant growth in profitability is underpinning the market cap growth that we've seen here. So we think it's, to a certain degree, kind of deserved from here, but the stocks do become more idiosyncratic as we look ahead.
I mean, you'd always want to be in the Magnificent Seven, really. I mean, if you want to win it, you got to be in it, just like the lotto. That's what they say, Scott. But, there are some things to think about in terms of valuations. We know that tech is where the growth is. But then you got to worry about, if you do talk valuations, then interest rates and the prospects for higher or lower interest rates can affect, where multiples go. They're going to be the fastest growing companies, but it doesn't mean that they'll be the best performing stocks.
I think that's spot on. So the way we've been discussing it is, that a lot of the discussion this week is CPI, Fed timing on first rate cut and so forth. And, we're very attentive to that for sure. But, for several months now, we've been saying we're much more focused on 10-year nominal yields than we are Fed funds, mainly because we do think, to your point, it sends a signal as to how the market will think about the valuation of these stocks. So, suffice it to say, we're using a year-end 5,100 target. We're not that far away at this point. Our mantra has been buy pullbacks, but part of what we're watching here is the direction of 10-year nominals. We feel much more comfortable with a valuation tailwind to the Big Seven with 10-year yields closer to 4%. We've nudged up to 4.25%, and we want to be careful to assess how the stocks could react if you were to work a little bit higher in the short term from here.
Becky Quick is interviewing E.J. Antoni from the Heritage Foundation, and he's going to tackle the CPI, Consumer Price Index. Now, I've covered this quite a bit in the past. The actual rate of inflation, according to a lot of economists, is not the CPI. The CPI excludes food and energy, for example, and they also use substitution, putting one item in for another to achieve their desired goal of inflation. So a lot of people know this. So it's quite a bit higher. The actual rate is quite a bit higher than 3.9%, but it came in higher than expected. So now you've got on the consumer side and the wholesale side higher than expected prices. In addition, I didn't know this, but in addition, the Fed is aggressively printing money. So M2, he refers to M2, which is the money supply, M2 continues to go up. So they're printing money while they're making these decisions of should we raise rates or not. So again, when you print money, you put more money in circulation, inflation is up. And then he asked Rick Santelli to comment at the end of it about the some of the areas of inflation, of high inflation, and Rick Santelli made a very good point. Some of these areas you can't fix. Car repairs, car prices, parts, insurance, utilities, things like this, they are what they are. And so Fed policy is not going to affect those kind of prices. So, the Fed can raise rates or lower rates, but I think we're going to be in for a period of higher inflation, and probably what will follow that is higher interest rates.
Okay, let's talk a little bit more about it. EJ, you want to weigh in on what you think's happening here and how big of a problem this is going to be for the economy, for the markets that have been waiting for a cut?
Well, in terms of the economy, I think this is a really big problem because what we've seen is M2, for example, not declining, not flatlining, but growing ever since October. The Fed is allowing it to grow because they're allowing all of this money to move out of sterilization to boost bank reserves. That's causing equities to go up, and it's also causing bank credit to expand. But the other thing that we have to really, really worry about here is the fact that the CPI is actually understating inflation. We talk about how there's this lag in housing and rents, for example, but we don't seem to be talking about the fact that the CPI is only measuring rents. Even the component of the CPI that tries to estimate the cost of home ownership still relies on rents. And because the cost of home ownership has risen 4 times as fast in the last 3 years as rents have, it has grossly understated the cost of home ownership. So instead of being up about 20%, it's actually up about 80%. But that's not coming through in these numbers.
Hey, Steve and Rick, let's say we're trying to figure out a scenario that makes Professor that we had on earlier, I don't know if you saw it, Rick, but Steve was referencing it. This is like the nightmare scenario, Steve. The professor thought that they're too tight right now. But let's say the economy just isn't cooperating, and neither is inflation. So they got to stay too tight for too long. Even though maybe they should be cutting, they stay tight, and eventually we get a slowdown or a recession. That's like a blast from the past, isn't it, where they can't get it under control, even though the conditions are already too tight. Is that how we get a recession eventually, Rick?
Well, listen, I think that the Fed keeping rates where they're at higher for longer is the right decision. I do think that there's certain aspects within the economy where prices are going to remain sticky. But the issue is, Joe, is that the Fed can't really help those areas, whether it's fire insurance, auto repair, the cost of autos, EV issues, all these things moving forward are not going to be slowed down in a dramatic way, no matter where the Fed pegs interest rates. Much of it is government policy, and government policy goes against economics, hence we have many of these issues. I think sticky inflation is going to remain, but I think it's a completely different animal than the type of inflation that we're most fearful of in the 70s.
Now, a very respected person on Wall Street in the financial industry is Jeffrey Gundlach. He is the CEO and co-founder of DoubleLine. And he's speaking down in Miami. He's speaking at the ETF conference down there. And so Bob Pisani picks up and does an interview with him and gets his take. And he's a very insightful guy. He refers to something that I have talked about before, and that is the macro cycles of interest rates. So I don't have a chart to show you right now. I've shown one before, but the macro cycle goes back. There's been two of them since 1946, so the end of World War II. So the 1946 to about 1981, 82 was the first cycle. So you could say, okay, that's about 35 years. From 1982 through 2021, that's 40 years. So that's the second macro cycle. And the chart that I have that I've referred to deals with bond yields, but bond yields track interest rates. So one has this incredible rise over 35 years from 46 to 82, and then a fall from 82 down to 2021, two macro cycles. And what he points out is we are 2 years into the next macro cycle. And we know this is the next one because we're coming off the bottom. The bottom was zero interest rates. So here we are. Yes, interest rates are up. Of course, inflation is up. But 2 years into a 40-year cycle, or you could say a 30 to 40-year cycle. Inside of that, what happens is there are spurts where it goes up and then it comes back down, and goes up and comes back down. But the long-term trajectory over that longer-term period is, for whatever reason, those were his words, I don't know either, but for whatever reason, that's the way it seems to work. So take a listen to Bob Pisani and Jeffrey Gundlach.
I want to hear from Jeffrey Gundlach, DoubleLine, of course, who joins us exclusively now on Closing Bell from the ETF Exchange Conference in Miami with our very own Bob Pisani. And Bob, what a day to have Jeffrey Gundlach with us today. Take it away.
And Scotty, it is a big day, of course. Jeff joins us here speaking, of course, at the ETF Exchange Conference. Jeff, you just addressed 1,000 people in the audience. Your basic message today, interest rates have bottomed. I want to talk about CPI, but get to that message right now. Interest rates have bottomed. What's the implications for that for investors?
Well, interest rates have very long cycles historically. For whatever reason, they tend to move in a broad trend for about 40 years. And we all know that interest rates kind of rolled over at very high levels a little over 40 years ago. And now interest rates are up over the last couple of years. So it's almost exactly 40 years. And I just think that interest rates were absurdly low, particularly real interest rates. And now real interest rates are reasonable. But I think that we have a problem with the amount of money we need to borrow. And that will cause a strange movement that we're all used to thinking that the economy gets soft and interest rates are taken way down by the Fed, and long-term interest rates also go down by a couple hundred basis points at least. But I got a feeling that when the economy weakens enough so that the Fed really does cut in earnest, I think we're going to be having a real big problem with people understanding how much debt expense we have. And they might start thinking that longer-term interest rates need to be at, well, they were 10% real yields in 1984. So it's not at all implausible that interest rates could go up into the high single digits. And it's part of this long-term trend. Now, one thing, I think that the economy is more vulnerable under a rising interest rate regime than it is under a falling interest rate regime. Under a falling interest rate regime, companies that are in trouble and maybe marginal credits even though they might have to pay more on a spread basis, they're paying lower interest rates. So they can refinance and take money out and reduce their interest expense. That prevents defaults. That supports all of the risk assets. They're reliant upon financing of marginal companies. But when interest rates are rising, maybe they'll have to default. So maybe it adds volatility to the economic cycle. And certainly that was the case when interest rates were rising in the 70s and 80s. There was tremendous economic volatility. So I think interest rate volatility and higher interest rates as a theme create more vulnerable markets.
Yeah.
And finally, I'll play a piece from Mohammed El-Erian. He's interviewing with Yahoo Finance, and he points out the what we can expect from the Fed, kind of the issues facing us going forward. He breaks it down to 3 items. Again, he's very succinct, and I think, as always, he's very insightful. Investors got very enthusiastic in early November, or you could even say 2023, but the market really took off in the beginning of November and has continued for about 3+ months. And what happens is when investors sense that things are going to turn favorable, in other words, in this case, interest rates are coming down, inflation's coming down, and it was, then they get ahead of themselves. And so they start, buying into equities and, bonds and, all kinds of things that push the market up. And so then when we get news like we did, where the CPI report, the PPI report, retail sales start to cool off, then I won't say the market crashed, because it didn't, but the market reacted quite negatively to this news last week. Anyway, here's some insights from Mohammed El-Erian.
I think investors should make 3 things. One is that the last mile, getting the 2%, is not going to be smooth. Second, that the marketplace had over-embraced the notion of a very soft landing that would allow the Fed to cut a lot. I think it's right now to listen to the Fed when they say 3 cuts, probably starting in September. At one point, the marketplace had priced in 7. So the marketplace has adjusted. And then the third element is to ask itself, why do we get such outsized reactions to data? The data miss wasn't that huge, but the market reaction was enormous. We saw yields move by 13 to 18 basis points in a single session. And that tells you a little bit about market functioning and depth. So take it away as, yes, it was a data miss, but I think it's aligning expectations more with what's likely to happen.
I saw this article and I wanted to show it to you. This was a piece that came out of Bloomberg, and it said Boston, just the city, not the state, but the city of Boston faces a $1 billion tax deficit from faltering office market. Now, I just covered that, about the difficulty with offices, which is tenants not renewing because of work from home, higher interest rates for refinancing, et cetera. So, but one city, think of that, Boston is just representative of all the cities. And some may be a little worse than this, some a little better, but you magnify that and think, okay, this is not the U.S. government, this is not the state, this is just a city. Where do they get that money to make up that deficit? Well, they're going to have to cut costs, layoffs, et cetera, but they're probably going to go into debt. They're probably going to sell some bonds, and again, you're sucking more money out of the market. So things like this don't really cause the economy to go well, and they don't even cause the market to go well. But I think we'll see, just tune your antenna on this one, that we'll see this year and next a lot of foreclosures, and I predict quite a few regional banks for sure that will be going out of business. People can sometimes get excited. We would all get excited for higher wages, but by the time inflation gets a hold of us, we don't have as much as we thought we did. Thank you for watching. If you have questions or comments, leave them in the comment section below.